In our previous video, I explained what market structure is, the basis and the foundation of market structure, and that was tagged part 1. In this series of market structure part 2, I will explain what fractal nature means and how it plays out in the market. If you're new to the channel, please smash the subscribe button, turn on the notification bell and the notification icon, click on the like and share this video to reach out to more people. You can also save it and watch it other times so you can comprehend. Remember, it is very important to rewatch all of these videos so you get the knowledge in full. So guys, let's engage on this video and let's learn. The word fractal means it was discovered by a mathematician in geometry. The word fractal simply means happening across all time frames. You know, in the Forex market, we trade based on timing. There's a 4-hour time, there's a daily time, there's weekly time, there's monthly time, down to 1 second time. We have minutes and we have hours and we have days and weeks and months, depending on the kind of trader that you are. Like in the previous video, I tried to explain kinds of traders. We have swing traders, day traders, and scalpers. Now, fractal means happening across all time frame, and I will try to explain this graphically. Assuming this was what price is doing, assuming this was what price was doing on the daily candlestick, consistently breaking structure to the upside, this means that if you scale down to the hourly or the 4-hour, you will see little break of structure around this zone. But because you're currently trading on the 4-hour, it explains it more. Just like this. And if you go down a bit, let's say to the 1 hour, it will be even more. This means that the market is fractal. If this right here is the movement on the daily candlestick, this means if you scale down to 4-hour on hourly, there are more movement, micro movement within that zone, because we understand that a 1-hour candlestick, a 4-hour candlestick, if we take this as our candlestick, if we take this right here as our candlestick, and this is a 4-hour bullish candlestick, it means that on a 1 hour there were 4 bullish candlesticks. 1, 2, 3, and lastly 4. If this was one bullish candlestick, let me move this a bit so you don't get confused. If this was one bullish 4-hour candlestick, this means that in that 4 hours of bullish price action, 4 micro candlesticks on the hourly happen. If you scale down to 30 minutes, it means 8 candlesticks on the 30 minutes happen. If you scale down to 15 minutes, you multiply, it means 16 candlesticks happen within that 1-hour frame. All of this is what is termed fractal nature of the market. All of this is what is termed fractal nature of the market. Like we see here, this is another clear example, and I try to explain this using graphs. And I'll take you to the chart so you understand. On a bearish price action, when you scale down to time, it means it is the same thing happening. So when you analyze the market on a higher time frame from a higher perspective, seeing it above ground, you tend to scale down and find that same thing. As a trader, it is important that you learn to navigate both of them at the same time, because this is what makes the difference. If you analyze a higher time frame and it is not in correlation pari passu with lower time frame, you have to go back a moment and recheck. Now, This simple logic in the structure of market makes a huge difference. And I'll take you to the chart so you understand. On this chart of the 4 hourly NZD JPY New Zealand dollar versus Japanese yen, pay close attention to this big impulse to the downside, this big bearish candle. On the 4 hourly, if I take it to 1 hour, then we can see how fractal the market truly is. Notice that that's one single candle now has 1, 2, 3, 4. Now has 1, 2, 3, 4 in it. If I scale down a bit, every movement within that candlestick is not properly explained with a lower time frame. If I take it down to 15 minutes, now by taking it down to 15 minutes, you see the candlesticks have increased within that box. Even at the bottom where we had some spikes to the top, you see it's changed from bearish candlestick to bullish candlestick. This is signifying that at this point there was some bullish pressure trying to push market up, and eventually it did. So as a trader, when you understand the basics of market structure, which is an uptrend is a series of higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows, while a downtrend is a series of lower lows and lower highs, lower lows and lower highs. We start our analysis from the higher time frame. This gives you an overall view and an oversight of the market at that time. Then you scale down to time frames that are less than where you got your overall market structure from. Then you start working. This is what makes the difference as a first trader. And it is important then you understand this principle. Remember that fractal nature of market refers to movements that happens in the higher time frame tend to happen in the lower time frame. It just goes to show that the forex market is in unity. If this is 15 minutes candlestick, it means that on a higher time frame, it might just be something like this. This covers it all together. That makes the difference as a forex trader. Now, if you tally this now with our previous knowledge on market structure, this gives you a balanced approach on the nature of the markets. So, how do we now interpret the fractal nature with the market structure? Because we understand that market structure can either be an uptrend, a downtrend, and lastly, a consolidation. This now gives us an edge in the market. We either trade an uptrend or a downtrend. Remember in the previous video, I told you never trade a consolidating market except you scale down to lower time frames. In my trading strategy, I almost never do it. Now, when you now have this understanding of the market, that the market is either on an uptrend, a downtrend, or a ranging market, or a consolidating market, we now interpret this with the fractal nature of the market. If you get an entry using 4 hourly candlestick, because 1 hour candle takes 4 hours to make, it might take days, weeks, or even months for trades to come back to your entry, because we always enter a trade at a zone that we are comfortable at, either from the top or from the bottom. Let's say, assuming this is where price is currently, and you are hoping that price will come down here and go up. This is where you are waiting for your buy, and you analyze this using a higher time frame like the 4 hourly. This might take days or weeks to formulate, because you are analyzing the market on a very high time frame, and the chances of it coming to your zone is high, but it will take some time. So what now happens then as a trader? You now scale down to the 15 minutes or 1 hour, or as the case may be 30 minutes, depending on the kind of trader that you are and the flexibility you have with time. You now scale down lower and you start looking for re-entries for price to come to that zone. You start looking for sells instead of buys for price to come to that your preferred zone. Then when price come to your zone, you do what? You buy the market. Same can be done if we invert this now. If I invert this, invert scale to a sell trade. Let's say this is where price is currently on a 4-hour candlestick, and you are waiting for price to come to this zone so you can sell. This is your preferred zone to sell from. Now, because you are analyzing the market on a higher time frame, it might take a long time, days, weeks, or hours to come to your zone. To keep you engaged in the market so you don't have become idle, you now scale down to lower time frames. When you scale down to lower time frames, you start looking for buys from this point where the market is currently. You start looking for buys to get to your zone. And when price, let me take this off the chart. And when price gets to that zone, you sell. This what makes you have a balanced approach to the market, because you are either buying, like it is, you are either selling or you are buying. Like in this case, you wait for price to come to your zone, then you buy. This whole graphical illustration reflects what we do in the market as traders. Now, to get a balanced approach, you must understand the market is fractal. What is happening on high time frames are also happening simultaneously on the lower time frame. The lower time frame has more candle, therefore has more explanation. But our advice as traders, you skip the lowest time frames like 1 minute or 5 minutes, and you scale up to a bit higher time frames like 15 and 30. So your executions are without a lot of noise. Noise in this case is a lot of candlesticks, because a lot of candlesticks tends to distract you from what the price is actually doing. Thank you for watching. Thank you for engaging up to this point. If you are new to the channel, please smash the subscribe button. Drop in the comment section how you understand this video and what I can help you grow and how I can help you understand the forex market properly. Thank you guys. See you on the next one. Stay blessed.